The S&P 500 just exited its longest bear market run since 1948. The popular US stock market index is now trading in the range of 4,300 points, its highest level since August 2022. In fact, the Monday closing price above 4,292 points means that the S&P experienced a 20% gain of the bear market low of 3,570 points set in October of 2022, meeting the widely used definition of the end of a bear market and the beginning of a new bull market. However, while the S&P 500 is up 12% this year, the majority of that performance is being driven by just a handful of stocks, and more specifically the big tech stocks Microsoft, Apple, Nvidia, Amazon and Alphabet that are part of the index. And there is a historically high spread between the regular S&P 500 index and its equal weight counterpart. So the big question is, can the big tech rally that is largely fueled by news about artificial intelligence spread to other sectors in the wider stock market, leading to a new and sustained bull market run? Or is the current bull run unsustainable, simply a fake bear market exit, and are investors ignoring many of the looming risks? And what does all of this mean for investors? Those will be questions covered in this video, and so without further ado, let's get started. So as we just highlighted in the introduction, the S&P 500 is up 12% year to date, and one can only speculate what has driven the very good stock market performance of 2023. As this infographic from Connor Leonard shows, short-term results are mainly driven by a change in investor sentiment, and some may argue that last week's stock market rally can be attributed to a surprisingly robust May jobs report, a resolution of the debt ceiling deal showdown, and investors' confidence that the US Central Bank Fed will not raise interest rates at its next policy meeting in mid-June. In addition to those factors, investors' bullishness on the impact of artificial intelligence on overall productivity also drove many tech stocks with AI exposure higher, led by the spectacular performance of Nvidia, which nearly tripled so far this year. As explained, the more recent run means that the S&P has finally been able to exit the bear market that started in early 2022. According to Dow Jones market data, the S&P 500 had been in bear market territory for 244 trading days, representing the longest period since the bear market that ended in 1948, which lasted 484 trading days. And as an aside, historically the average bear market has lasted 142 trading days. However, it's worth noting that the commonly cited S&P stock market index is actually more concentrated than most people and most passive investors in particular may think. And that's because the typically referenced version of the S&P index is a market cap weighted version. A market cap weighted index is a type of index in which the components are weighted according to the size of their total market capitalization. As of June 5th, the top 5 constituents of the S&P represented around 22.5% of the index, and as this chart here shows, if we consider the last 3 decades, this is a historically high level of concentration. Now interestingly, if you compare the 2023 performance of the market cap version of the S&P 500 to its equal weight counterpart, meaning that in this version each company is weighted equally as opposed to in proportion to its market capitalization, well then you can recognize one of the widest spreads ever. While the S&P is up 12%, the S&P equal weight is basically flat for the year. And as highlighted by Bloomberg, this is the biggest outperformance of the market cap index since 1999. And this makes sense because, as we've just shown, the top 5 positions in the S&P represent almost 25% of the index. And if you now compare the performance of these top 5 positions, Apple, Microsoft, Google, Amazon and Nvidia, to the performance of the S&P, well, you can identify a significant outperformance in 2023. I've also read that just 7 companies accounted for 95% of the S&P 500's total return this year as of late April 2023. And the index would actually be negative for the year without the contribution of the 7 big tech companies. So in a way, these numbers highlight that the impressive 2023 run of stocks so far is rather fragile, as it relies on the performance of just a handful of stocks. And of course, a significant price decline in one of these major constituents of the S&P could of course start driving the entire index down. And apparently this is what some hedge fund investors are seeing as well, to quote from a Wall Street Journal article. As the indexes have climbed this year, so has the short interest in the market. Bets against the S&P 500 have climbed steadily to 487 billion, though that is down from a peak of 558 billion in November 2021, according to technology and data analytics company S3 Partners. And the big tech names that have rallied more recently seem to be particularly popular shorting targets. To quote from the article again, last month investors added 3.57 billion to their short positions against Tesla, 2.5 billion against Nvidia, and 7.26 billion against Facebook parent Meta platforms. So what does all of this mean for investors? Well, actually I have a lot of interesting thoughts on this subject, so please bear with me for a few more minutes. First, sure, the gap between the big tech names, the mega caps, and the rest of the market has never seemed so big. And as I said, just 7 companies accounted for 95% of the S&P 500's total return this year. And without them, the media's headlines would, certainly look completely different. So is this healthy and sustainable? Well, I think there are 2 possible scenarios worth thinking about. And the first one, the answer to the question, is this run sustainable, is it depends. Whether the just started bull market can reach higher levels and continue for possibly multiple years depends on the fundamental development of the underlying businesses, as well as the valuation these businesses are trading at. In fact, the top 5 positions could represent 50% of the index, which would mean, an insane level of concentration, especially for a broad stock market index. But this wouldn't necessarily worry me as long as the underlying businesses are responsible for the majority of profits of the 500 biggest companies in the US. So if the level of concentration is backed up by earnings power and a bright future outlook, this wouldn't necessarily a big deal. Although it would most certainly increase the level of volatility for the index, which in turn could lead less experienced investors to make costly mistakes. So again, is the most recent bull run sustainable? Well, to answer this, we would need to take a closer look at all of the top constituents and then conduct a fundamental analysis and assign a fair value to them, which of course goes beyond the scope of this video. But very briefly, I believe that Nvidia is most certainly not trading at a healthy valuation right now, and I believe the stock will eventually come down. This is something that I explained more in depth in one of my recent videos, so if you're interested in this subject, make sure to watch this video next. But other tech names such as Meta and Google appear to be more reasonably valued and might actually have more upside left. Faber has recently also shared some very interesting data on this subject, highlighting that the world's largest market cap stocks tend to perform rather poorly going forward once their weight reached a certain size. So this is certainly something worth thinking about. Now, another interesting aspect that we could look at is the long-term performance of both S&P 500 indices, so the equal weight index and the market cap weighted index. And obviously there are advantages and disadvantages to both approaches. Market cap weighting, for example, obviously leads to less turnover and causes less friction by trading fees, leading to theoretically lower expense ratios. On the other hand, market cap weighting by its very nature tends to buy high and sell low, meaning that as the price of a stock goes up, regardless of the development of the underlying business, the index will have to increase its exposure to this stock and vice versa. If we now look at the very long-term performance of both of these indices, we can see that there are periods in which the market cap weighted version outperformed, and then there are periods in which the equally weighted S&P 500 outperformed. However, in the long run, these are very similar indices. Although, if we look at the past 20 years, the equally weighted index actually outperformed the market cap weighted S&P by quite a margin. But just to be clear, this doesn't tell us anything about the returns going forward. If we now consider a more bullish scenario, well, then you could argue that surely the big tech names have done very well in 2023. But what about their performance in the past year? I think it might help to remember that the top 5 names that had a great run in 2023 actually had a terrible year in 2022. All of them underperformed the S&P, and an equally weighted basket of Meta, Alphabet, Microsoft, Amazon and Netflix was down 47% in 2022. So sure, the big tech names are driving the market gain this year, but let's not forget that they were big losers last year, which is also why the market cap weighted version of the S&P actually underperformed the equal weight index in 2022. So according to this logic, many of the tech names may have some more upside left in them, especially if the underlying businesses start showing more significant growth again going forward. We've also referenced an infographic earlier highlighting that short-term results are mainly driven by changes in investor sentiment and investor psychology. So if you take a shorter term view, well then you could argue that the strong gains of the big tech names might also spread to smaller, large and mid-cap stocks. Investors may be worried about missing out on broader stock market gains and start looking at these names too. So this fear of missing out is certainly what's partly driving certain phases of a bull market. Now, to wrap up, I would argue that investors shouldn't read all too much into all of these short-term price movements of broader stock market indices, regardless of whether it's a market cap weighted index or an equally weighted index version. Preparing this video and looking at all of the data was certainly a lot of fun, and it's fun to talk about what the market may or may not do in the short term, but longer term, the market and in particular individual stocks are driven by changes in valuation multiple, earnings growth and the underlying return on invested capital. I think this is what investors should focus on. So these microeconomic factors that are relevant to the company and its industry, and they should do all they can to ignore the macroeconomic chatter and absolutely avoid trying to attempt timing the market based on this information. Now, to learn more about this philosophy and to become a better investor, make sure to watch the following video next. Take care.